This is a story about a dude named Lane. He moved to the mainland and bought one place to stay. And then one day he went try to rent them out. And then he became one real investor man.
Hey guys, it's Lane with the Simple Passive Cash Flow Podcast. Please go to iTunes and leave a review. I'm really trying to get higher and more big name podcast guests. Please go to iTunes and leave a review. Good or bad, I don't care. Today I have Russell Marsan on. How you doing, Russell?
I'm doing great, Lane. Thanks for having me on today.
Russell works for IPX1031, and I thought I'd bring you on and let's talk about 1031 since we're in the seller's market and a lot of our properties have appreciated recently, or a lot of us are sitting on equity, lazy equity. And if you guys go to simplepassivecashflow.com and type in that article I wrote about figuring out what's your return on equity, a lot of people who bought their property more than 5 years ago are probably making less than 5%. And I always say, if you're making less than 5%, shoot, you're probably better off in a savings bond or something, safer than what the stock market is. Kind of go over the overall 1031 concept. I did a 2-property 1031 into 9-property, a bunch of turnkeys and single family homes a couple of years ago. So I'll try and interject here and there. I've probably done this about 1 billion times. So why don't you take it away?
Sure. Yeah. Well, the 1031 exchange, as you just expressed it, it's a great way to build wealth. It's actually the greatest wealth building tool in the entire Internal Revenue Code. There's nothing else that allows taxpayers to achieve financial planning to the extent that Section 1031 does. But even though it's the greatest wealth building tool, it's one of the most underused revenue codes because of the fact that most people have misconceptions about what a 1031 exchange is. They think maybe you have to find somebody to swap with, or that you have to, you can only exchange land for land and houses for houses. And there's just a lot of misconceptions about the 1031 exchange. The basics of 1031 is you get to list and sell your property to, whomever wants to buy it. It's just like any other transaction that you're trying to sell a property. The person that's buying the property from you that you're selling, say you own a rental property and you've owned it for many years, and like you stated, maybe it's not giving you the rate of return that you really want on it, but you have a ton of equity in that property, so you'd like to exchange that into something that maybe produces better cash flow if that's what your objectives are. So you want to sell the rental property, you list and sell it to anybody, whoever wants to buy it.
Yeah, so just to use myself as an example, I was sitting on quite a bit of equity. I had bought my homes in the 2011 or 2009, and again in 2011 I was sitting on lazy equity there, and I wanted to get at that equity. And when an investor has equity, you have 2 ways of getting at it. You can either refinance it, or I chose to do this 1031 exchange because my properties were in Seattle, which has really no cash flow, and the rent to value ratios are pretty poor there. So I did the thing where I transferred my properties from an appreciation asset to a cash flow asset. So that was why I chose the 1031.
Saw great appreciation in a short time period. And that's where most investors start, right? They buy their first rental property and they're really going after appreciation because they have very little money. So they want to, build one. They want to build money. They want to build equity. Once they have a substantial amount of equity, then it's time to start thinking, okay, well, how can I better position this equity into cash flow so I have a better return on investment on my money? There's other objectives as well, though. Sometimes it's even maybe, well, I want to get into less management headaches, so I'm going to exchange into that. Or maybe I want to build a dream house someday and I want to buy a piece of land that I can do that on in the future. There's all different types of objectives that you can you can do within a 1031 tax deferred exchange. It's kind of like almost like the sky is the limit in 1031. But it allows you list and sell, and then you have the time frames of 45 days after you close escrow on the one you sell. You have 45 days to identify, 180 days to close. So you have roughly 6 months to sell up after you sell a property to go out and find and buy replacement properties. And you can mix and match several types of properties. Like your description of what you were able to do, you sold 2 properties and bought 9. That's fantastic, but most people don't understand you can do that. They think you have to sell 1 for 1.
Yeah, so let's back up a little bit. I think the whole reason why you're doing this 1031 exchange is, say you have a property that's you sell for $450 and you bought it for let's just say 300, and you have $150,000 of equity bump. Because it's not a primary residence, you have to pay taxes on that $150,000 gain. So that's going to go right to your income statement there, and you're going to have to pay taxes. So by doing this 1031 exchange, you carry that forward, and you can, in theory, carry this forward forever.
Absolutely. And in fact, in the great state of Washington, a lot of people just decide they're not going to do an exchange because they think they're going to only pay 15% in taxes, because there's no state tax, which is one of the great benefits in living in the state of Washington. But the reality is nobody ever pays 15%. Now, capital gains tax on, for example, your example, Lane, of the $150,000 of gain, that's taxed at a rate of somewhere between 15 and 20% now for federal purposes. And then there's also additional taxes now that most people don't know about. There's also a 3.8%, which is the net investment income tax, which was created to fund the Affordable Health Care Act. So that's another 3.8% as well. And then what you alluded to a moment ago of the $150,000, that's just gain. There's also what's called depreciation recapture. So, when you depreciate an asset, then all depreciation you've taken over the years is recaptured upon sale, and that's taxed at a much higher rate. That's taxed at 25% to the federal government. So taxes are pretty substantial, even for a Washington state resident. And you're correct. Yeah, once you sell, if you do an exchange, you get to defer all those taxes. And a lot of people think, well, taxes are inevitable because in life, right, two things are inevitable, death and taxes. But that's not actually true. The death thing, yeah, that's inevitable, but the taxes are not, because current estate tax law is very favorable. The estate tax doesn't even kick in for federal tax purposes until amounts that exceed over $5.4 million per spouse. And the heirs also get a step up in basis. So, if Lane, you bought a property when you were very young for $100,000, and when you pass away, that property is worth $1 million. It was under the 5.4, so there's no estate tax, and also your heirs get a step up in basis. So their basis in the property, as soon as they take title to it, is the fair market value as of the date of your passing. So if it was worth $1 million, even though your basis was $100,000, their basis is $1 million. So they can sell it the day after they inherit it, and they don't even need to do a 1031 exchange because they have no profit. There's no gain there. So yeah, taxes are not inevitable. You can, in a lot of cases, carry the deferral your entire life and then eliminate it.
All right. So before we get into the mechanics of the 1031 exchange, that's the 1031 exchange is just one tool in the toolbox. Some of the drawbacks that I personally see for myself, I'm actually looking to sell my portfolio and possibly put it into multifamily syndications. And there's some limitations with the 1031 exchange there. And, some for more conservative investors, I think the 1031 exchange is a good way to keep leveling up bigger properties. But it's a little annoying doing these transactions, trying to time the sale and trying to time the purchase of the new asset. Like right now, take, for example, it's a seller's market. Yeah, you can get a good price, but what else are you going to put it in? I mean, if you're under the gun, under a time limit, it's just very hard to find decent investments. But hey, you might be fine with decent investments. So the saving the taxes might be the better way to go. So Russell, let's kind of go over the 180-day and the 45-day rule, just so that people can understand the constraints here.
Sure. So those time periods that you just stated, the 45-day rule and the 180-day rule, those time periods are concurrent, and they both begin at the close of escrow of the first property sold. So if I'm selling one property and buying one property, when I close on the property I'm selling, that has started my clock. So from that closing date, I've got a maximum of 45 days to name and identify properties to the qualified intermediary, that's us. And we have a total of 180 days to actually get those properties closed. Before the 45th day, a taxpayer can change their identification all they want, but after the 45th day, they can't. So they're set in stone on only closing on something that I've identified. And you stated correctly, this being a seller's market, that's the number one killer of 1031 exchanges right now, is that 45-day rule. So it's really important that people that are engaging in 1031s begin to look as early as possible, and don't even wait until day zero. Before day zero, before you've closed on your relinquished property, find your replacement property, try to get into contract on it as early as possible to help kind of, better secure your exchange from being successful past the 45th day.
All right, so if you use myself as an example, I sell my property, but then even before I sold my property, I was already letting my agents and my turnkey providers know, like, hey, I need inventory, guys. So even a few weeks before that, I was already getting the inventory that was in the pipeline, so I could put it on this 45-day list. So I already had a draft list going like a week or two before my property sold. I mean, when your property is going to sell. I mean, you're already in escrow and doing all that, so you have time to plan. But it's when the day zero starts and you start going through properties, I mean, it's hard because you're going through due diligence. And by the way, you should never buy a property cash only and with no appraisal. That's just a recipe for a scam right there. And a lot of turnkey providers are doing that these days. But back to the 1031 exchange, you should always be looking ahead, because one or two properties might drop out, and I had to get 9 properties. That was my magic number to use up all my available funds. And you don't have to use up all your funds, but definitely to optimize it, I had to be. It was hard to find inventory. Did I think I left anything out there, Russell?
No, discussing, I think it's pretty pertinent to discuss that 45 days, like you're talking about here, because like I said, that's the number one thing. So kind of what we're seeing is people will say, okay, well, I only want to buy 1 property in my exchange, but I'll identify 3. And then it goes past the 45th day, and the one that they're in contract on falls out for whatever reason. And then they name 2 other backup properties, so they'll go ahead and write up an offer on those. Well, in this market, those backup properties don't wait. So in a lot of cases, if you can't close on the one that you really are in contract on, the one you really want, and that one falls out after the 45th day, then your exchange, there's a high percentage of the probability of that exchange failing because the properties are not around anymore. So that's why, one of the products now on the market, a lot of people are using as a backup position because it's guaranteed to be around, is what's called a Delaware Statutory Trust. And it's like a percent ownership of large commercial buildings, where these sponsor companies will take down 4 or 5 buildings, create this Delaware Statutory Trust, and then they sell off, basically pie-sized interests of the Delaware Statutory Trust. And it is a vehicle that can be 1031 exchange. So by naming something like that as a backup property, that's guaranteed to be around if you're not able to, whatever reason, close on the one that you want, or you just can't find something in the 45 days. Because if your clients are looking in the Seattle area, that's a hot market, and it's tough to get into contract on properties, and 45 days goes by pretty fast. So in some cases, people decide to I'm going to take advantage of a seller's market right now and take my big equity position and just park it for a while in something like that type of product, and then wait the market out, and then reposition it somewhere else.
Yeah, that 45-day rule is the hard thing. I mean, it's like you write a list of all the people you potentially want to marry at age 25, and if they're gone or taken, you're SOL, right? Like you just can't pick anybody else. And I have a few articles on simple passive cash flow. If you guys just Google search on there, 1031, got a bunch of just random tips to when you go through yours. But yeah, they definitely want to get into that Delaware Statutory Trust. What you're doing there is you're paying your money you close on the property, your sale, the money goes into a trust in your name. And then what happens from there?
Well, so what happens first of all, so you close on your relinquished property, and let's say, you sell for $500,000, and it's all cash. but once you close, the $500,000 is now sitting in the exchange account with a qualified intermediary. Now, then you identify a Delaware statutory trust because you decide, that's something that really fits you in this market now. Then that's the exchange proceeds would end up going into that and closing in that. And basically, the way that structure works is there are corporations called sponsor companies. And you can Google DST or Delaware Statutory Trust and see how this structure works. But basically what they'll do is the sponsor companies will buy, 4 or 5, 10, 15, $20 million commercial buildings, apartment complexes, whatever the strategy is for that particular sponsor company. And then they'll take down and buy those properties, and they'll own it under a Delaware statutory trust. And then what they'll do is attract in 1031 investors. Say, here's the portfolio, here's the product, here's the return. How much would you like? And so you're selling for $500,000 in your exchange. So they say, well, great, here's a $500,000 slice of ownership of this Delaware statutory trust in these properties. Then you're paid. It's a very passive form of ownership. They're all triple net lease properties. So owners in that structure don't have to do anything. There's no management. They don't even pay property taxes or insurance. It's all taken care of by the tenants. So
that would be
passive.
That's a like-kind exchange from real estate into triple net.
Yeah, the IRS came in. The IRS created the revenue procedure that defined that as being an exchangeable type of product, the Delaware Statutory Trust. Now, so I guess one of the downsides to it, though, is that there isn't really an exit strategy on demand. So if you do buy into something like a Delaware statutory trust, and then 2 years later something else comes on the market in Seattle, and you say, wow, I'd really love to exchange out of the DST and into this property that's for sale near my home, well, you really can't do that. So you really have to wait for that property to go full cycle. Typically, the Delaware statutory trusts do turn over, but it's various different rates depending on what's happening in the market and the objectives of that sponsor company. So it could be 5 years, it could be 7 years, but there is no early exit strategy.
So you don't have control over it.
That's correct.
Yeah, might not be a bad idea if everyone's thinking that we're 2 to 3 years away from the top. That surely the DST exit would be past that point. But
yeah, and even just like in your example of paying taxes on $150,000, I mean, if they want to take advantage of the seller's market and keep that equity and then put their equity into something that's going to give them a good cash flow that's very passive for a while, then it's a good vehicle for it. They'll have options down the road to reinvest in something else, just not right away.
What kind of rates of return are you seeing in these DSTs?
Yeah, I can't quote those, so you'd have to.
I'm guessing it's super low because.
No, it's actually not bad. So, but I definitely recommend you, because it's anybody that owns single-family rental properties is not going to be getting the rate of return they're going to see from these DSTs from a cash flow standpoint.
I'm just seeing it as a product where they know that the 1031 exchanger is desperate.
No, because there's a lot of product out there, so they have to make their product more attractive than the other competitors. So no, they're not trapping 1031 investors; they're attracting them actually.
So let's talk about another avenue, which is the reverse exchange. How does that work?
Yeah, that's really common. That is a very timely subject in this market, because we've talked about that 45-day rule, and I know that I can sell my property in 10 minutes. For full price or maybe even above price. But what I'm afraid of is selling my property in 10 minutes and then looking on the market and not being able to find a property. So I'm really afraid of doing an exchange. So there is what's called a reverse exchange, which allows a taxpayer to buy a property first. So theoretically, you can take all the time in the world to scour the market, find your perfect property, and then go into contract on it, and then actually close on it, and then sell your property afterwards and complete that as a 1031 exchange. Now, that sounds wonderful, and I guess the obvious question in most people's minds listening to this would be, wow, why doesn't everybody do that? And I guess the simple answer is that not everybody can financially not everyone can financially afford to be able to do a reverse exchange because it's a very different animal than a forward exchange. In a forward exchange, you sell a property first, and then you go out within 180 days and buy something. So that exchanger is never on title to both assets at the same time. In a reverse exchange, you have to buy a property first and close on it, but you haven't sold one yet. So the IRS, one of the stipulations is that the taxpayer cannot be on title to both properties at the same time and still be allowed 1031 deferral. So what happens in a reverse exchange structure is we, the qualified intermediary, have to park title to one of the properties. We'll actually create a single member to hold title to.
That was a single member LLC again? It broke up a little bit.
Yeah, okay. Yeah, we create a single member LLC, and it's called, for exchange purposes, that LLC is called an EAT, an exchange accommodation title holder. And we create an LLC for every individual transaction for every reverse exchange because you don't want your clients' assets commingle with somebody else's. So yeah, we create that EAT, that LLC, and it's going to either park title to the one they're buying or the one they're selling. In most cases, it's the one they're buying. So what happens is, even though we're going to go on title of the property, we're not actually going to come up with any cash for it. So the taxpayer has to give us the money. We give them a note and deed of trust for those funds. They're basically giving us a loan so we can buy that replacement property. We then go on title and acquire the replacement property with the funds they gave us. After closing, they have 180 days to get their property sold, and then funds from that sale come back in and they actually pay off that source. So wherever the taxpayer pulled that money from to lend to us to buy the property, that gets replaced at the end of the exchange from the proceeds of the relinquished property.
All right, so if you got to have pretty substantial liquidity to front the money on the purchase of the new property.
Yeah, that's the big thing, right? That exact issue, because normally you sell a property first and then you have this big pile of cash to buy something. Well, you haven't sold anything yet in a reverse exchange and you have to buy something first. So where's that cash coming from? So you're exactly right. The taxpayer has to have access to a large amount of cash. And if not all cash, he has to have at least the amount of cash that's equivalent to the equity in the property he's going to sell. It's not something somebody just can't come in and put 5% down and try to do the reverse exchange. They have to have access to cash. It can come from anywhere, that cash. It can be borrowed against their primary residence. It can be pulled out of a bank account. It can be borrowed from a friend. It doesn't really matter where that comes from, but those funds cannot be tied to either property. They have to be equity coming in.
Yeah, something I'm thinking about right off the bat is a lot of these guys I talk to that call me, they got these huge HELOCs.
Yeah.
So this would be a good avenue for that.
Yeah, HELOC is the most common way that we find in reverse exchanges that people use to front themselves the money to do the reverse exchange. And then also, we're going to go on title to one of the properties, but we don't want to control or manage that property. So during the exchange, we triple net lease that property back to the taxpayer. So they're actually going to have control over that asset during the entire exchange. And then if it's not a residential 1-4, if it's another type of property, we're also going to need a phase 1 environmental on it as well, because of the liability of anything toxic potentially being there. So you can begin to see that this type of transaction is much more complicated, which means it's considerably more expensive as well. A regular forward exchange is only about $1,000 total in costs. A reverse exchange, the fees begin at $5,000 and can go up from there.
Right, whereas the regular exchange is probably about a tenth of that.
Yeah, it's about $1,000 for a regular forward exchange. Total cost, sell one, buy one. But in a reverse exchange, our fees are going to be a minimum of $5,000. It can be higher than that, but even if it was at the $5,000, there's also going to be additional fees because when we take title to that property, that's an actual transfer. So there's one extra transfer in a reverse exchange that doesn't happen in a forward exchange. So there's going to be more title and escrow fees, excise tax, all that stuff.
When I got smart and sold my primary residence to start investing in investments that actually made sense, woo! I needed a place to diversify quickly as opposed to some money market or some high reward checking account. Let's face it, turnkey rentals are cool and syndications are great, but they don't come around often. I stumbled upon the American Homeowner Preservation Fund. The owner, George Newmary, once apartment syndicator too, is now sponsoring the podcast. His fund cuts the middleman out to crowdfund the solution to the mortgage crisis in America. They are empowering you to fund the purchase of distressed mortgages and earn returns that smoke any other passive fund. If you find something else better out there, let me know. Oh yeah, they work with families to keep them in their home after buying the underwater note at a huge discount. It's an opportunity to make an impact on families and communities while earning returns. Start investing with as little as $100 in investinahp.com. If you want the free Burn Zone book, please send me an email at lane@simplepassivecashflow.com.
Just getting back to the DSC, the Delaware Statutory Trust. I've heard of some of these go wrong. Where exactly do you have to look out for as a consumer? Where do people get in trouble with these?
Sure. Well, the Delaware Statutory Trust, we haven't seen issues so much with them. There is a lot of bad taste in the mouth of taxpayers from the previous real estate cycle, because something back in the just prior to 2000, there was what was called tenancy in common. An entire industry kind of popped up using the structure of tenancy in common ownership for large commercial buildings. And it was a similar structure to the DST. There would be a sponsor company, and the sponsor company would buy, a property, and they would attract in 1031 investors. But instead of buying into the trust, you'd be buying actual tenancy in common ownership interests. So it was a little different structure. The IRS did create a revenue procedure which outlined if a sponsor company did these things, then the IRS was willing to issue a private letter ruling to allow that to be 1031-like kind property. The problem with what happened there was that last real estate cycle was crazy on the uptick, and you had just a handful of companies that had been around a long time with these types of products, done great due diligence, had great performance records, and were just really, great companies to invest with. And those companies are actually still around. But what happened was there was so much money being made because there was so much property being sold and so much gain and so many exchanges that industry just exploded. And so sponsor companies were popping up like crazy, and they were not doing due diligence on the assets they were buying. They were projecting, long-term investment numbers and return on investment numbers based on short-term financing, which doesn't work. And then what happened was in that last bad real estate cycle, residential real estate is typically, on average is around a 30-year mortgage. Well, that doesn't happen in the commercial world. Typically it's, 5 years. And so these notes are being with great interest rates. They locked in for the 5 years, but then when the notes were called in 5 years, the economy had already started to turn. Nobody was refinancing them. The rates were much higher, which turned those assets upside down from a return standpoint. And so those properties just started failing left and right. And it's really because of the negligence of a lot of the companies that just kind of sprung up and wanted to make a lot of money. It was just kind of a greed thing. That's not this is a different structure. Similar product, which is a great product to have for if you want to go passive and actually not have to pay the tax through an exchange and have options down the road. But this Delaware Statutory Trust is a much easier type of thing to exchange into, basically.
Would I be able to create a Delaware Statutory Trust, have people come into my simple passive cash flow fund? Is that an option for me?
You would want to research it yourself. I can't give out that kind of advice, but as a qualified intermediary, but you'd certainly want to, see what the structure is and whether or not you could meet the guidelines for it.
So it'd be the like kind would be the main thing.
Well, just Yeah, because you have to follow the guidelines of what that Delaware Statutory Trust is in order to qualify as a like kind asset. But if you do, then yeah, you certainly can.
All right, so I got a scenario here, and this is kind of my scenario. I've got all these rental properties that have appreciated a little bit, and me personally, I've got a little more experience. I'm ready to take off the training wheels. So currently, my whole portfolio is on sale right now, stabilized portfolio. Am I able to use this Section 721 as an option to trade into multifamily LLC?
Well, so you can use Section 721 allows you to basically donate your real estate to a partnership interest. So you'd want to talk to your tax advisor to see if that works in your scenario. But it is not, obviously it's not Section 1031. And where we see 721 most commonly used is in what we call UPREITs. And I think all of your listeners have probably heard of REITs, real estate investment trusts. When you buy into a REIT, you're not buying real estate, you're buying shares or stock, and you cannot exchange into any type of stock. So therefore, a REIT share is not like kind. But there are some of the REIT companies have facilitated the Section 721, which allows the taxpayer to kind of donate their asset to the REIT. And in return, the REIT issues them operating units that they can eventually cash in for REIT shares. So that section code does allow a real estate investor to eventually get into that type of position that's non-real estate. But of course, once you get into that, you can never back out. It's a one-way street. But then when you do get into that, when you do get into a position where you own stock instead of real estate through Section 21, one of the the downside is you can't exchange back out into real property without paying tax. The upside is you can liquidate at whatever your pace is. Because if you had one $5 million piece of property, if you sell that in 1 year, you pay all your tax in that year that you sell it. If I instead go into this type of situation where I now own stock through Section 721, then I can liquidate that slowly, right? I can sell 20 shares this year and pay my tax, 100 shares next year and pay my tax, so on and so forth.
Oh, I see. So I can take the 10 properties I've got, put it into an LLC, and then sell off shares to other people. Is that the mechanism?
Yeah, it would not be a 1031 type structure. So,
but I would essentially delay the taxes, but then as I sell off the shares, I would sell it off one by one and ideally try and keep myself out of that top tax bracket.
Yeah, if you were able to use a 721 and you did go from real estate into some type of stock position, then yeah, you could liquidate at your own pace and pay your tax, because you are deferring the tax even when you do that. So the tax is still sitting in there in your stock. So when you sell it, you will pay the tax. It's just you only pay it at the pace that you sell each share.
Right. So instead of this huge, like some people have got like $100,000, $200,000, $300,000 gain,
yeah,
they can leak it out slowly.
Yeah, and bear in mind too, because you mentioned LLC, that any tax-paying entity can do a 1031 exchange. So corporations, LLCs, all S corps, they can all do 1031 exchanges. It's just that the same tax-paying entity that sells must be the same tax-paying entity that buys. And you cannot exchange into or out of a partnership interest. So, if you and I and someone else had a 3-member LLC, and you wanted to be bought out of our LLC, then we would bring in cash and we would pay you and we would buy you out. That buyout of you is not an exchangeable transaction, so you would pay tax. Me and the other partner, we could still do an exchange and sell that asset as the partnership, but that anytime somebody exits or enters a partnership, that is not an exchangeable type of transaction.
Oh.
But what you can do is, season things. So if, for example, you and I as buddies, we're in a 2-member LLC and we owned a rental property for 10 years, And then we decided, well, we want to go our separate ways with our equity. And we want to do an exchange, but we don't want to go together. What we'd want to do, because you and I, as that two-member LLC, held the property for a long time, so our LLC clearly qualifies for 1031 deferral. But you and I as individuals don't, because you and I haven't owned the property as individuals. The LLC's owned it. So what we'd want to do is dissolve that LLC at least a year in advance of the sale, deed out as tenants in common. If we want the liability umbrella of an LLC, we can both create a single member LLC and be tenants in common with each other. But we'd want to season that for at least a year, get that on our individual tax returns, and then sell it and do an exchange, and then we can go our separate ways.
Any examples from some unique situations that you've worked with that might bring the awe factor to some folks?
Yeah, in fact, the great state of Washington just gave us the most recent controversial 1031 case in just August of last year. I think everybody pretty much is familiar with the name Bartell in the state of Washington. And there was actually a famous case, Bartell, which is a pharmaceutical retail. They did what's called a build to suit exchange. So similar to a reverse exchange, you can do what's called a build to suit. So let's say you sell something for $10 million and you found some land for $1 million. And then, so you sold for 10 and you bought for 1. So that doesn't, you pay a ton of tax. So instead, I want to use the other $9 million to build on the land that I'm buying in my exchange. It's called, and you can do that. It's perfectly fine. You do what's called a build to suit exchange. Well, in this case, there was no way that he was going to be able to build within 180 days. So he entered into a build to suit exchange, and he took almost 2 years to complete his exchange. The IRS back in 2000 created a safe harbor, their revenue procedure stating, if you follow these guidelines, then your reverse or build to suit exchange is okay. And one of those guidelines is you have to do it within 180 days. And so he did it outside of that safe harbor. He went beyond 180 days and he filed that as a 1031 exchange. And it's been in federal tax. It was in federal tax court for many years. They rendered their decision in just August of last year, which actually the federal tax court agreed with Bartell, and they allowed the tax deferral of 1031 from that exchange, which was kind of a shock to everyone. So that was rather interesting. They have not, since then they've issued that they are not going to acquiesce. So they're not agreeing with that. So they're going to continue to challenge any type of non-safe harbor exchanges like that, where people go outside the time frame. But nevertheless, it was an interesting kind of event that happened within Section 1031.
Right. Yeah. These rules change all the time.
Yeah, absolutely. And a lot of them are based on, case law, private letter rulings, things like that. Another great one was one that happened. It was a build to suit also, but what happened was he bought from a related party and did a build to suit exchange, there's special rules for related parties. The IRS doesn't like it when you use a related party to buy from. And in most cases, they disallow that type of exchange to even happen. So what happened was a taxpayer, a guy, he owned, several different entities under LLCs or corporations. He sold a piece of commercial real estate. And what he did was he wanted to acquire a piece of land that he owned as a related party to himself. And he wanted to build on it. So how he kind of circumvented the IRS's guidelines in all of these issues was he actually did a 30-year lease. So he sold his commercial building. His replacement property was a 30-year lease from his related party, which anything over 30 years is actually like kind to real property. Did a 30-year lease. Entered into a build-to-suit exchange, so the intermediary built on the land that the related party owned. Once the building was done, then that lease was transferred to the exchanger. And the IRS actually approved that structure, which we all thought was kind of crazy because that's really outside the box thinking. Because a couple things were done wouldn't be normally allowed in an exchange were allowed in an exchange in that scenario.
So if an investor has a bunch of equity they're sitting on, and the general rule is you need to do a like-kind exchange, and you're sitting on real estate, how can you do a like-kind exchange into something different, like gold or artwork, or what are some things you're seeing people exchange out of real estate to still invest?
Sure. Well, first of all, just the like kind, what most people don't understand is that like kind is such a broad definition within real property, because you can exchange, if somebody's coming out of a high equity position in a rental house, they can exchange that for land. They can exchange it for commercial, apartments, industrial, 30-year greater leases.
Triple nets too, right?
Yeah, triple net leases, absolutely. You can go into, mineral rights. So, oil and gas leases, those are actual real property rights. So, those types of things are exchangeable. Once you get into the personal property realm, which is a lot of things, that could be, equipment from anything you depreciate, like a farmer has tractors or fisherman has boats. Those things are all exchangeable, but once you get outside the realm of real property, like kind means actually like kind. So, you have to exchange an airplane for an airplane or a boat for a boat. You can't exchange a boat for an airplane. And you mentioned some arts and collectibles. Those are exchangeable also. So if somebody wants to sell, rare coins, they can exchange into other rare coins. Bronze sculptures, fossils, kind of muscle cars. All of those things are exchangeable, but they are not exchangeable with real property. So it does have to be real property to be able to allow that tax deferral from the sale of real property into, whatever the replacement scenario. Just recently had a client called me, and they owned 5 domino franchises in Las Vegas. They did not own any of the real estate. It was all leased buildings, and it was just on the franchises.
So that's owning a business, right? Not a real property.
That's owning a business, yeah. So his broker told him you can't. But what he really wanted to do was he wanted to buy real property in an exchange. His broker told him you can't do it because you don't own any real property. His CPA told him the same thing. Well, he got my phone number, and so we chatted, and it turned out he was able to actually do a substantial amount into real property because he knew his lessor. Because I asked him, I said, can you go back to your lessor, and you only got 10 years left on your lease, but can you push that out to 30 years? All you need to do is get 2 10-year options to extend. And if those options are transferable to any buyer, then you've just created like kind. So he was able to do that with his lessor because he knew him very well. And so he was able to section out, a value of his sale to go towards real property. He also had, he had done tenant improvements to his property. He had done cost segregation. Which is personal property, but it's personal property that's within real property. So he found replacement properties that had similar fixtures that he could also do cost segregation on. So he was able to actually put a substantial part of his sale that was, look on surface like there was no real property there. But in reality, he was able to transfer a lot of that in tax deferred into real property.
So I'll ask the question, if you have a bunch of equity in real estate, can you go out and transfer it into a Jamba Juice or a Froyo franchise?
Well, you can't, not the franchise itself, but although the franchise, the value of the franchise is actually exchangeable. So if you were selling a Jamba Juice franchise and that value, you wanted to go out and buy, another like kind franchise, you could do that. It's just not real property. Mm-hmm. But it is exchangeable with something similar.
Would you say if you had a business like a Jamba Juice franchise or a fishing business and you were to transfer it into a boat, would you be able to do that? And maybe
No.
use that boat on the weekends for fishing, for fun,
Yeah.
or live in it?
Yeah. So that would be a tax advisor question. But so you can't. So first of all, when you get into personal property realm, in real property, like kind is the wild, wild west. It's like all real property is like kind with all real property. But in personal property, it must be the same asset class or user code. So you can't sell, a Jamba Juice and buy a fishing boat. In fact, it's pretty specific. You can't sell a 7-Eleven franchise and buy a Burger King franchise because that's not really the same asset class. It would need to be, kind of convenience store to convenience store or fast food to fast food. So it's pretty specific, and you can't cross over into different asset classes like from, fast food to fishing.
Interesting. Well, so the 1031 custodians, are you guys lawyers or CPAs, or what realm do you guys fall in?
That's a great question. I wish everybody asked that question. So as a qualified intermediary, I give accredited courses for attorneys and CPAs. I actually teach them. But in order to do what we do, you don't have to be a CPA. You don't have to be an attorney. In fact, to be a qualified intermediary, there's no licensing requirements whatsoever. So literally, if I'm not a related party to you, then, or if I don't have an agency relationship with you, so if I'm not your attorney or your CPA or your broker, then I can be your qualified intermediary. So, and it's scary because there's literally been over $1 billion lost through this last bad real estate cycle by qualified intermediaries because it's an unregulated industry. So, people have to be very, very careful of who they use before they ever decide to go with a qualified intermediary, because there's an assumption, the realtors, lenders, title companies, they're all regulated heavily, but we unfortunately are not. Our parent company is Fidelity National Financial. We're the largest qualified intermediary in the nation. We're a Fortune 300 company, and we have the highest level of financial security and transparency of anybody in the business.
Right. So like if a lawyer screws up, you can kind of go after their license, but if you guys screw up, there's no license to go after, so it's the parent company.
Yeah, well, and also, well, in a lot of cases, it's just there's no way to go after, period, right? As I don't know if you're familiar with Land America Title. Land America Title was the third largest title company in the nation. They were brought down by their 1031 company that they owned, which was a smaller competitor of ours. What they were doing is they were investing while we hold title to your client's funds during those 180 days, we can legally invest that money any way we see fit. And what that company was doing was they were investing their clients' funds in auction rate securities, which at the time were paying out 6%, which is phenomenal if you think about it. From a standpoint, I don't even know why they charged a fee, because that's making a lot of money off your clients while you're holding their funds. Well, auction rate securities got froze when the market turned, and they couldn't close their clients' exchanges. So ended up taking down the third largest title company in the nation when I went into bankruptcy because of it. We can't do that. Our parent company is actually the largest title insurer in the world. So we voluntarily have the highest level of security. We have a $100 million Fidelity bond. We have $50 million performance guarantee and $30 million of error and omission per transaction. And also the clients, they're named on the bank account with us. Their money's not commingled with anybody else's. They will earn the interest while we're holding it, not us. So, they have to ask all these questions before they agree to do business with anybody to make sure their money's safeguarded, because it's not mandatory.
All right. Yeah. Well, a lot of good information. I think we went a little bit off topic there, but it's good fun and good way to test the understanding.
Yeah.
Russell, anyway, people get a hold of you, want to leave your contact information? Sure.
My cell phone is I manage all the Western United States for the company, so I travel around quite a bit, but I'm always reachable by cell phone, and that's 530-755-8355. And then also our website is www.ipx1031.com. And then my email address, very simple, russell.marsan@ipx1031.
Well, I appreciate you coming on. Definitely a lot of things to think about. Again, it's a tool in the toolbox, not for every situation, but definitely a good one to, I did it. I think I'm probably going to just eat the taxes on the next one, but yeah, definitely learn about it and try and apply it to your situation, guys. We'll talk to you guys later. Bye.
This website offers very general information concerning real estate for investment purposes. Every investor's situation is unique. Always seek the services of licensed third-party appraisers and inspectors to verify the value and condition of any property you intend to purchase. Use the services of professional title and escrow companies and licensed tax, investment, and/or legal advisor before relying on any information contained herein. Information is not guaranteed, as in every investment there is risk. The content found here is just my opinion, and things change, and I reserve the right to change my mind. Above all else, do your own analysis and think for yourself, because in the end, you are the only person who is going to look out for your best interests.